Welcome to the Explainer. Look, jumping into the Missouri housing market without a solid, data-driven plan, that's pretty much a one-way ticket to major financial stress. Buying a home is a massive deal, right? And honestly, it is so easy to get totally swept up in the thrill of house hunting. But today, we're taking a step back. We are skipping the emotion and diving straight into the hard data. We're going to explore exactly why using a Missouri-specific mortgage calculator is an absolute, non-negotiable must before you even think about signing a single piece of paperwork.
So here's a really simple question for you. Is your dream home actually in your budget? We all do it. We get completely caught up in the emotional high of finding that perfect house. You know, the one with the stunning kitchen and that huge, beautiful fenced-in yard. But get this. According to the data, the absolute biggest financial mistake of your life can happen the very second after your offer is accepted. If you haven't done the math beforehand, trying to connect the reality of that dream home with your current bank account, well, it can be a massive, terrifying shock.
And you know why that shock happens so often? It's something called buyer's amnesia. People tend to focus entirely on the sticker price of the house and saving up for that initial down payment. But they completely ignore the really complex monthly math that kicks in right after moving day. I mean, it's so easy to just look at a listing price online and kind of guess what you might owe every month, but guessing is a huge trap. We really need to turn those vague guesses into a precise, data-driven plan.
Okay, moving right along to Section 1, uncovering the hidden costs.
Because honestly, finding the right house in Missouri is literally just the starting line. When you break down the anatomy of a real mortgage payment, it's like a pie with 4 distinct slices. Paying back the actual money you borrowed, the principal, is just one single slice. Right next to it is the interest, which is basically the cost of borrowing that money over time. Then you've got your property taxes and homeowners insurance, which usually get bundled together into an escrow account. And depending on how much cash you put down up front, you might be stuck eating a 4th slice, PMI. So yeah, your actual monthly payment is vastly more than just paying off the physical house itself.
Let's put a real-world, local perspective on this. Take property taxes, for example. These numbers vary wildly depending on exactly which zip code you're in. If you're looking to buy in Jackson County, Missouri, property taxes sit right around 1.14%. And that local rate, it significantly inflates that escrow slice of your monthly payment. If you're just relying on some generic national calculator online instead of plugging in local Missouri data, man, your budget is going to be fundamentally broken from day one. And then, oh boy, there's PMI, private mortgage insurance. If you don't put a full 20% down at closing, you are getting hit with this. Think of PMI as this invisible fee that completely protects the lender in case you default on the loan, but you get the privilege of paying for it. It absolutely drains your wallet, tacking on an extra yearly cost of anywhere from 0.46% to 1.50% of your total loan balance. Now, eventually, once you build up 20% equity in the home, you can usually get it dropped. But until that day comes, it is a very real, very heavy burden on your monthly budget.
All right, let's jump into Section 2, the tool of empowerment.
This is exactly why using a Missouri mortgage calculator isn't just a neat trick. It is your ultimate shield against the unknown. There's a great quote that really captures this. The secret to successful homeownership is not just finding a house you love, but finding a loan structure that fits your life. A good calculator takes all those scary variables, your principal, your interest rate, the length of the loan, and instantly makes sense of the chaos. It essentially guarantees that your new house payment isn't going to accidentally derail all your hard-earned retirement savings.
A truly great calculator also pulls back the curtain on something called amortization. Amortization is essentially the timeline showing you exactly where your money is going every single month over the entire life of your loan. It breaks down that crucial, slow shift between just paying the lender's interest and actually paying down your own principal balance.
If you look at a standard 30-year journey, the shift is pretty dramatic. In year 1, the vast majority of your monthly payment is just going straight toward interest. You're essentially paying a heavy fee for the privilege of borrowing their money. But fast forward to around year 15, and things finally start to balance out. By year 30, your payments are aggressively attacking the principal. This is the literal financial journey of shifting away from just covering your costs and finally building true wealth and home equity.
Now for Section 3, the power of scenarios. This is where the calculator truly turns into a financial crystal ball. Just look at how rapidly your monthly commitment can jump with just a few tiny tweaks. Let's say you have a $200,000 loan at a 6.5% interest rate. That gives you an estimated payment of about $1,264 a month. Not too bad, right? But bump your budget up to a $250,000 home at that exact same rate, and suddenly you're at $1,580. Now, what if you stretch to a $300,000 loan and the interest rate happens to tick up slightly to 7%? Boom! You are suddenly staring down nearly $2,000 every single month. I mean, that is a completely lifestyle-altering difference.
Which brings up a super vital question for us to consider. What happens if interest rates change by just 0.5%? Because, as we all know, the housing market is constantly fluctuating. Even a tiny little 0.5% shift can completely rewrite what you can comfortably afford to buy. Honestly, it is remarkably smart to run these calculator scenarios with a slightly higher rate, just to build a nice little safety buffer into your plans. You also really need to weigh out the different loan terms. A 15-year loan, for instance, typically offers lower interest rates, but it forces a much, much higher monthly payment on you right now. On the flip side, a 30-year loan gives you a lot more month-to-month breathing room in your budget, but you are going to end up paying significantly more total interest over the life of that loan. So it's this constant balancing act between protecting your immediate monthly cash flow and maximizing your long-term interest savings.
Bringing us to Section 4, making smart financial choices.
Before you go and completely fall in love with a property, you have got to set up some financial guardrails. Financial experts pretty much universally agree on what's called the 28% rule. Basically, you should never ever spend more than 28% of your gross income on housing costs. And yes, that means principal, interest, taxes, and insurance all combined into one number. If your calculator spits out a monthly payment that pushes past that 28% mark, well, consider that a blaring red flag.
Furthermore, to really protect your overall financial health, your total debt-to-income ratio, often called your DTI, must stay strictly below 36%. That 36% includes your new housing costs, plus all the existing baggage you might be carrying, like car loans, student loans, or credit card debt. Crossing that 36% line is dangerous territory. It means your new house could actually start actively sabotaging your retirement planning and completely drain your emergency funds.
When buyers decide to just ignore these calculations, they walk right into some very common, very painful budgeting traps. They misestimate the current interest rates, they completely forget to factor in those specific local property taxes, and they almost always overlook the hidden ongoing costs of basic home maintenance and utilities. Using generic, broad estimates leads directly to severe buyer's remorse down the road, and that is exactly why inputting precise, localized data into a Missouri-specific calculator is absolutely non-negotiable.
So here is your actual step-by-step roadmap for success. Step 1. Gather your precise data. No more guessing. Use your real credit score, your exact planned down payment, and the actual local tax rates for the county you're looking at. Step 2. Run multiple what-if scenarios in the calculator to really test your absolute financial limits. And finally, Step 3. Consult a local Missouri mortgage broker. These folks know the state's tax laws inside and out, and they can offer you customized strategies that a computer simply can't. Completing steps 1 and 2 prepares you to actually have an informed, serious conversation when you get to step 3.
Buying a home is an incredible, life-changing milestone. But let's be real. It requires cold, hard data, not just hoping for the best. I highly, highly encourage you to run your own numbers today. Discover your true limits and take total control of your money before you ever set foot inside an open house. Because ultimately, you have to ask yourself a tough question. Will your Missouri dream home be your greatest financial asset or a 30-year financial trap? The math holds the answer. Thanks so much for joining me on this explainer, and happy calculating.